So my name is Christopher Potter, and I am presenting my project on Walmart, Amazon, and eBay. So here's just a brief history about the three companies. So Walmart was founded by Sam Walton in Rogers, Arkansas in 1962, and he was inspired from his recent success in his small town dime store. It took off when him and his wife moved out into the country, and they started a store in the small town. And it was pretty much a store where you could go to get everything you would need for living. The company went public in 1970 and had great success, which led them to steady expansion for their business. Since they started in 1970, Walmart has expanded to 11,443 stores across the United States and internationally. They become one of the largest companies in the world. Amazon's history was formed by Jeff Bezos. He had the idea of Amazon. He started in his garage in Washington State. They turned their first profit in 2001, which was about quite a few years after they first started the company. And today they are the world's largest online retailer, and they also own many other large companies worldwide. eBay was formed by Pierre Omidyar, founded in 1995 during their dot-com bubble, which was part of the reason it was a huge success. They currently operate in about 32 countries, where people are able to buy and sell products using auction-style sales technique. eBay recently had to find many ways to improve their site, since Amazon especially has really taken over part of their industry. Some of the products, so Walmart has home goods, cleaning supplies, groceries, sports goods, lawn and garden, pharmaceutical, electronics, and home maintenance. So really they have just about anything you can need. Walmart has it, they carry it. And actually same thing with Amazon. Amazon is kind of the online version of Walmart, except for they're really taking over Walmart by storm. eBay is a little bit different. They have clothing, cleaning supplies, pet supplies, sporting goods, collectibles, auto parts, electronics, and home maintenance. And again, it's auction style type of sale. So you bid against other people. A lot of times it's used. It can be consumer to consumer sales or producer to consumer sales. So some of the analysis, financial analysis pieces. So first is going to be, we're going to have some leverage ratios. Leverage ratios are used for measuring the amount of capital that comes from a company's debt. They're used to evaluate debt levels of the company. So debt to equity ratio is the ratio that calculates total debt and financial liabilities against stockholders' equity. So through this chart, we can see that eBay has quite a bit. They really drastically took off in the past couple of years with their debt compared to stockholders' equity. And Amazon has slowly gone down, which is good because at first their startup costs were really high, so they had a lot of debt. So times interest earned. Times interest earned measures a company's ability to pay interest payments as they are due. So we can see through this one that Amazon has, from 2015, they started in 2001, but they really took off in 2011. So we can see that through that, they've really taken off over the past couple of years. Even through their numbers, it would show that. They're the only one that really have a steady increase. They have a slight downturn in 2016 to 2017, but that's because they were revamping their motto and also revamping some of their supplies and things that they offer. The free cash flow per share is a ratio that measures the company's ability to attain long-term assets. So again, eBay is kind of on the downward slope of its company. They're not doing too well anymore because of the competition that is Walmart and Amazon mostly. Amazon, again, we can see that from 2016 to 2017, it took a dip, but since then it's been constant growth. And same thing with Walmart. Walmart took an overall dip. However, they've realized since then what they're up against, and they've changed their model a little bit to fight against it, which is why we can see that it's starting to go up. The debt to equity ratio measures the amount of assets given from debt. So again, we can see that Amazon peaking at the top is on its way down. Same thing with Walmart. Walmart started to go up at the end of 2019. That could be because of the pandemic, which also made most stocks tank during that time, which really hurt those companies, but not in the long run. We can see eBay had a steady increase, but unlike Walmart and Amazon, eBay's turned down, which could be because they're not going to recover from the loss that they took. Liquidity ratios are used to determining whether the company has the ability to pay off long-term and short-term debt. So the current ratio, this ratio tells whether a company can pay off its short-term liabilities with current assets. So we can see that for a while, eBay especially was going straight down, and that's because they weren't able to pay off their current liabilities with their current assets. And that could be because of the market, but it can also be because of the competition that they were up against taking over some of their industry. And since 2019, eBay has started to revamp their supply and their motto and change out the way they do business with releasing new products and their own products that are different from Walmart and Amazon. And with Walmart and Amazon, we can see that they're very constant, which is a good sign to invest into those companies. The asset test ratio. This ratio tells whether a company can pay off its short-term liabilities with quick assets. So quick assets would be considered your inventory. So we can see that Amazon and Walmart are able to do that, and that's mostly because they own most of the products that are on their sites, and they're able to have so much capacity and products that they're able to pay off those debts. eBay, on the other hand, does not own all of the products on their website. They're taking a portion of the sale price, which is why we see that their line decreases steadily. However, again, in 2019, they revamped their organization. They started with different processes, which is why it's seeing a return. The operating cash flow ratio measures the amount of times a company can pay off current liabilities with cash. So pretty much how much cash do they have on hand to pay off their current liabilities, which could be for up to a year. So again, we can see eBay not looking too hot. They're not one that I would recommend investing on upon this graph, especially is because they're not able to pay off their liabilities with cash. They've been steady down for about 6 years now. We can see Amazon and Walmart, though, they're much more steady across the bottom, which means that they're able to pay off all of their things with cash, which is the goal of their company. Activity ratios or efficiency ratios determine and measure how effective a company is at utilizing its assets. So an asset turnover ratio measures the company's ability to generate sales from their assets. So this is going to be your net sales divided by your average total assets. So here we can see where the companies are at. And the reason why these lines are separated so much is because the amount of sales that they have over time. And I would expect to see Amazon start increasing. But Walmart has so many products that when you go to the store, typically you don't buy just one. You buy many, many products. So let's say you buy 50 products compared to your Amazon shopping where you might buy 5. Yes, you're going to Walmart, maybe you order on Amazon more, but in total, when you go to Walmart, you're ordering more products. You're buying more products, which is why their asset turnover ratio is much faster than eBay or Amazon, mostly because that you don't typically buy as many products. The reason why eBay is so low is because more people use Amazon than eBay, which is why that would mean that they don't turn over their assets as fast. Your accounts receivable turnover measures how many times the company can turn its receivables into cash. So Walmart, again, very high, and this is because they turn over their products very quickly, unlike Amazon and eBay. Amazon has slowly gone down, which is surprising, but this could also be because of the market change. And I wouldn't worry about this too much for the company itself, as they seem like with the rest of the graphs, they're doing extremely well. So with your profitability ratios measure the degree of success or failure of the company for a given period of time. So from the profitability ratios, we have the profit margin on sales, which shows how the company is managing its finances overall. So this is a very important graph to look at when you're considering investing into a company. because it can show you what their expected growth could possibly be. And also, are they going to be there in 5 years, or are they managing their finances over well and not taking on too much debt, which they're not able to pay off? So this is a very interesting graph because we can see that eBay kind of is all over the place, especially in 2016. And this is in 2019 also. And this is because in 2016, going into 2016, they took on a big task of revamping their market. And in 2016, that's when it became not just a auction style website to buy and purchase, just a regular buy and purchase consumer to consumer website where anyone is able to buy something for a set price. Unlike what it had previously been, is where it was auction style only and you had to buy whatever you were bidding against other people. In 2017, it took a huge tank, and this is potentially because of some of their products not doing as well and overall people losing interest in the market, and also because in 2017 Amazon took on Prime, which definitely helped their sales. And the other two companies remain pretty consistent, again, which is what we're seeing throughout the rest of the graphs also. The gross margin ratio is this shows comparison between gross profit and net sales of a company. This shows the company's profit after cost of goods sold. So we can see that Amazon and Walmart are low, but eBay's high. And this is because now eBay doesn't necessarily own all of their products, but so the ones that they do own, their gross profit margin is very good. Same thing with Amazon. Amazon doesn't own all the products on their site, but they do own some Amazon specialty items, which they have a good profit margin. Walmart, on the other hand, owns all of their products, so they go for the same They go for the same margin of profit through all their products, which is why they would also be the lowest on this site. The operating margin ratio shows and compares operating income of a company to their net sales. Again, we can see that the operating margin for eBay is high, and this is because they do not have many costs that associate with their company, since they are strictly only a buying and selling consumer to consumer or producer to producer or producer to consumer. They don't have many debts or liabilities that go along with them. Amazon and Walmart, however, they hire employees, so their operating margin is a little bit lower, and that's because they have to pay these employees and pay the people that maintain everything that go along with the business. The return on asset ratio measures the overall profitability of the assets. The return on asset ratio is going to be your net income divided by your total assets. So as we can see, Walmart and Amazon are very steady, and that is I believe that is because of their products being very steady, and their assets they have very good assets. eBay, on the other hand, again fluctuates heavily in 2017 and 2019, and this is because of them revamping their system. The return on equity ratio measures the profitability of owners' investments. So as we can see with Amazon and Walmart, they're pretty steady again, and this could potentially be because their owners are still returning a lot, spending their money and returning it into the company as the company's still expanding. We can see eBay taking off, and that could be because they might be expanding, or they might be maxing out their company and their reaches. So the bottom line ratio shows a company's income after all expenses have been taken out. So again, we can see Walmart is at the top, and this is because that their philosophy and their system, they make a lot of profit off of their small items. Amazon, however, they have a lot of higher dollar items where the profit margin might be a little slimmer. eBay being at the bottom, and this is because they don't necessarily own all their products, so it's based on consumer to consumer. Market value ratios and coverage profitability. Market value ratios help evaluate share price of the company's stock. These are going to be, in my opinion, the most important ratios because this really tells you whether to invest into the company's stock or not. The book value per share ratio measures the amount each share would receive if the company would liquidate. So this pretty much means that if the company were to go liquidate all of their assets, would they have enough money to pay you, the owner of the assets? As we can see, Amazon here, they have taken off over the past couple years, and that's mostly because they have gotten so big. Walmart, slight increase. They always have been around. They've always done the kind of same tactic, and I think that they're so big that they'll be able to continue this tactic no matter how well Amazon does. eBay, on the other hand, has remained relatively flat, and that's just because eBay's became less and less popular in the past couple years, and when the interest spikes, it's only for a couple months, not for a long period of time. Earnings per share ratio measures the income earned on each share outstanding. So again, Amazon taking way off, and that would be because that their growth is just a crazy amount and they're making a lot of money, which means that they're able to pay off each person and each share is worth a lot of money. The price earnings ratio measures the ratio between market price per share to earnings per share. So as we can see in 2015, that the return on the investment was really good for Amazon. That's because the price wasn't too high. However, now that's steadily gone down because the price of Amazon stock is high and the return isn't much better. Same thing with Walmart. Walmart has gone up, but it's also gone down because the stock's high value and it's not worth, we're close to the median point of what the stock's actual value is. The dividend payout ratio measures percent of earnings distributed in form of cash dividends. So surprisingly, Amazon has never had a cash dividend, which is why we can see that this line is flat. Walmart has gone up from 2018, but however, in the past couple of years, they've not been able to pay, they haven't paid their dividend, so that's why it has gone down drastically. eBay in 2018 began paying cash dividends to try and incentivize people to invest in their company, which in my opinion was a smart move. However, it did not work in the long run, which is why it tends to go down in 2020. So the conclusion, in my opinion, currently the most stable company to invest in out of Amazon, Walmart, and eBay is going to be Amazon. And we can see this because majority of Amazon's ratios are pretty stable when it comes to the ones that involve risk, their turnover rates, their assets, liquidity, and things like that. However, their earnings per share is all high, and that's because it's a popular stock currently, and they're being so successful. We can see from the graphs that the other two companies, more so eBay than Walmart, tend to jump around quite frequently, which is not helpful when it comes to people trying to invest into their stock. People get scared and sell out when it's low, and or people get scared and do not invest when it's low. When it's high, they want to sell out because they don't actually have a care in the company. Walmart is pretty steady, and we can see this as why I would tell you to invest in the Walmart second, because they have a steady growth and they're just such a big company that would be hard to get rid of them altogether. Most important part is to see if they've paid their dividends, and if they were going to go under, would they still be able to pay you, the investor? And Amazon and Walmart, I would definitely say, would have no problem based on how many assets they have. They would be able to pay you with the revenues from the assets if they liquidated all of their supplies, which means that they'd be a good company to invest into. So overall, I definitely would say that Amazon is your best purchase currently, with Walmart coming in second, and eBay, I would say, is slowly on its way out. So I would not recommend purchasing any eBay.